Hi guys, welcome back to my channel. Kelvin here. Whenever you look at any investment videos or blogs, they will always recommend you to buy stuff. Like buy this fruit company now or retire on this stock now. But it's very seldom that you will come across articles that tell you when to sell. As a result, many people don't know when to sell a stock. And when they sell, it's usually a panic sell. Then the guy be like, he panicked so? Pump it. And you will end up missing on the chance to go to the moon. And you'll be sad. So in this video, I will tell you when is the correct time to paper hand and sell your stock. But before I start, I would greatly appreciate it if you can help to tap the like button because it will help out with the channel. In return, I will show you a dog eating ice cream. Alright, let's start right now. Okay, so obviously the worst time to sell is when you hear about some global bad news, then panic sell. Here's why. If you look at history, there's always something bad happening. But throughout it all, the market has continued to go up because stonks. So if you had sold here, or you will have lose out on all the gains. Or if you always try to sell high, then buy back when it's cheaper, it's very likely that you will underperform over the long term because you need to sell at the correct time, then buy back at the correct time. Personally, I wouldn't try to time the market because I'm already a noob in timing stance in LOL in the first place. With that being said, here are a few rules as to when you should sell. First, change in profitability. So for new investors, whenever they see the stock, they be like, stock price. They see the stock go up, they be like, this is a good stock. Or when they see the stock go down, they be like, this is a bad stock. Well yes, but no. If you look deep enough, there's actually a real company with real buildings, real people, and real earnings. Yes, it can affect the stock price in the short term. But over the long term, what affects the stock is the earnings. Earnings good, stock goes up. Earnings bad, stock goes down. So simple. But it doesn't mean that you need to sell immediately when the earnings drop. Like when Netflix earnings drop, sell ah! What you need to look at is the long-term earning growth. So let me give you a few examples. One of the best examples is Singapore Press Holdings, SPH. Part of its revenue comes from newspaper advertisements. You can see that over the years, print ad revenue has been going down, and even the digital ad revenue has been going down. Why? Because there are many other places where you can read news, and best of all, there is no paywall. Because of that, SPH long-term earnings will suffer. Another example is oil companies. Yes, oil is doing well right now, but there are predictions that oil demand will likely peak by mid-2030s and will be eventually replaced by clean energy. In fact, you can already see more and more EV cars around you. When that happens, you can be sure that the profitability of oil companies will drop. One more example, a while ago, Warren Buffett sold his airline stock because he felt that due to the pandemic, people would travel less and the profitability of airline companies will drop. With that being said, I know sometimes it's hard to know when there's a change in fundamentals. Like, it's not easy to know when Google stops becoming a good company or when Tesla is a bad company. So, Ticker Genius has a very good method for this. Basically, whenever he buys a stock, he writes down what are his reasons for owning the stock and what will be the reasons for selling the stock. For example, for Tesla, he buys it because it forces other automakers to transit, improving Tesla batteries and eventually full self-driving. And he will sell if Tesla batteries are unable to scale or if Tesla's full self-driving growth starts to slow down. Or for Palantir, he buys it because he feels that Palantir's commercial revenue will grow. More and more companies will use Palantir and there's a 100% year-on-year growth for commercial revenue. But he will sell if Palantir can't onboard new developers to Foundry, retention drops, or commercial growth starts to flatten. So in short, whenever you buy a stock, you need to know what's the reason you bought that stock, and not just, I like the stock because he likes the stock. Once you know your reason for buying the stock, if that reason is no longer valid, then you can sell the stock. Second, better opportunities. Always remember that the reason you buy a stock is to grow your money. If you feel there's another stock that can give you better returns, just switch over to the new stock. The term for this is called opportunity cost. For example, maybe you bought a bad stock and it goes down 60%. Then you'll be like, I will just hold on and wait for it to recover. Can, no problem. But while you are waiting, all the other good stocks are going up and up, while your stock stays flat and you wait long. And it doesn't have to be a bad stock. sometimes it can be a good stock too. So it's important not to get too attached to a stock. In the 1958 letter, Warren Buffett mentioned that he had to sell a bank called Commonwealth Trust, even though he felt that the stock could go to the moon. The reason was because he found a better company called Sanborn Maps, which had a monopoly at the time, and it has almost complete immunity to recession and lack of need for any sales effort. In my case, even though I have a ton of Tesla in my portfolio, if ever I see something that's better than Tesla, I'm ready to sell it anytime. Like maybe the other company has better competitive advantage, it's disrupting the industry, it has a higher growth rate, then I'll just sell my Tesla stock and switch over. And of course, I will let you guys know. Next, you can also sell the stock when it has become too expensive. Then you'll be like, I thought you said don't time the market. Okay, personally, I don't use this strategy because while this strategy is valid, it's actually not easy to do. So I'll first talk about this strategy, then share how I would do it. The idea is that you should sell the stock once it has become too expensive. The way to see is by comparing the PE ratio to the industry. Just in case you don't know what's PE ratio, it's just price over earnings. For example, if PE ratio is 5, it means that investors are willing to pay $5 for every $1 of earnings. But every sector has a different PE ratio. For sectors that have a slow and steady PP growth rate, like financial sector, the PE ratio is about 13.5. While for the technology sector, which grows fast and furious, it has an average PE ratio of around 29. So remember a while ago, Google was going to the moon? At one point in time, it reached a 38 PE ratio. But there's something called mean reversion, meaning that after a while, the PE ratio will revert back to the mean. And guess what? After Google's PE ratio hit the peak, the stock price started to flatten and eventually went back down. Another example is Bank of America. In 2021, the PE ratio went too high, but it came back down. However, there's a famous saying, markets can stay irrational longer than you can stay stolen. So just because PE ratio has went up too high, it doesn't mean that the stock will crash anytime soon. The PE ratio can continue to stay high as long as investors are confident in the stock. For example, you can see that Amazon's PE ratio was super high for a very long time. If you have sold just because it has a high PE ratio, then you'll be sad because the stock had just 3x in the past 5 years. It was only very recently that the stock price started to flatten and the PE ratio slowly going back to the mean. And yes, this includes Tesla. Will the stock crash? Maybe. But as long as investors are confident in the stock, it can continue to go up to the moon. However, eventually Tesla's PE ratio will still go back to the mean. For it to happen, either Tesla's earnings will have to go up or the price crash back down. So because of how hard this strategy is, I don't personally do it. But if you really want to use this strategy, you can do it using something called covered call. I won't go too in depth, otherwise this video will be longer than the Batman movie. Basically, instead of selling the stock immediately, then regret when the stock goes up, what you can do is sell a call option against your stock and receive money by doing so. If the stock goes up, great, you get to sell the stock at the price that you are willing to sell. But if the stock doesn't go up, awesome, you still earn some money and you get to keep the stock, which is nice. Anyway, if you want to know more about covered calls, you can check out this video here. Finally, you can sell a stock when your position has become too large. And again, disclaimer, personally, I don't use this strategy. But I know a lot of pro investors do it. Basically, when you invest in stocks, you want to keep the portfolio as diversified as possible. That means if the stock has gone up too much, the portfolio percentage will go up too. You want to sell part of the stock to minimize your risk. The percentage will be different for everyone. For example, there's a 5% rule of investing where it says you shouldn't have more than 5% of holdings in your portfolio. For Warren Buffett Koko, it's 40%. The reason I don't follow this strategy is because I like to live dangerously. Just kidding. It's because as long as I'm confident in the stock, I'm okay with owning a huge percentage of it in my portfolio. What I will then do is adjust its percentage according to my conviction. So let's say if I buy Apple, maybe at the start it's just 10% of my portfolio. But if over time I become more confident in Apple, I can increase Apple's percentage in my portfolio. In short, this is not a hard rule, You can just tweak it according to your comfort level. So anyway, that was some quick rules on when to sell your stock. Hopefully now you know when to diamond hands and when to paper hands. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.